Hello everyone, and welcome to another edition of IronFX Viewpoint. I'm Marshall Giller, head of Global FX Strategy here at IronFX. Last time, I discussed what the market is forecasting for 2014, and which currencies are expected to do best and the worst. This time, I'm going to discuss why you shouldn't believe a word of what I said, or at least you shouldn't trade on it by itself. The reason is, when I talk about the market consensus, really what I mean is the median forecast. That is, various data suppliers compile lists of forecasts by banks and other firms that do research on the foreign exchange market. They then calculate the median of those forecasts, the rate at which there are the same number of people forecasting higher as there are forecasting lower. That's taken to be the market consensus. But, of course, it's not a consensus at all. Not everybody agrees on that rate. On the contrary, by definition, there are some people who think it'll be higher and some people who think it'll be lower. In fact, usually there are more people who think it will be either higher or lower than there are who think it will hit the consensus level. For example, let's look at the euro-dollar forecast during 2014. In this graph, the red line represents the median forecast, what we take to be the market consensus. The green line is the highest forecast that anyone is making for the dollar against the euro, while the blue line is the lowest forecast for the dollar. You can easily see three things from this graph. One, there are different opinions on where euro-dollar is headed. Some people think it'll end the year higher than it is today. Some people think it'll end the year lower. In other words, not everyone agrees with the market consensus. Two, the distribution is skewed to the bottom. That is, more people think euro-dollar will end the year lower than think it'll end the year higher. 3. Furthermore, those people who think euro-dollar will fall think it will fall further. Then those people who think it will rise think it will rise. Is that clear? Maybe not. That is, the median forecast is for euro-dollar to fall by 6.2% from where it is now by year-end. But even the most extreme forecast for a rise in euro-dollar are that it will rise only 4.1% from here. On the other hand, the most extreme forecasts on the downside are for it to fall by 13.5%. So, people think the downside risk for euro-dollar is much higher than the upside risk. Now, I'd like to show you this graph. It's a graph of how that median forecast for euro-dollar at end 2014 has changed over time. Again, the median forecast for end 2014 is in red, only this time, the blue line is the actual euro-dollar rate. Three things stand out. One, the forecast for end 2014 has been pretty constant. The lowest was 123, the highest was 141. That's a 15% range compared to a 22% range for euro-dollar over the same period. Since the beginning of 2013, the forecast has remained in a very narrow range between 123 and 129, only 5%. 2, the forecast is generally mean reverting. That is, when euro-dollar moves up, like in 2011, people expect it to move down again in the future. When it moves down, like in mid-2012, people expect it to move up. This is probably a good thing. It shows that people aren't just moving their forecast around in response to moves in the market, but rather that they have an idea about where fundamental value for the currency lies and expect it to move towards that point over time. And 3, the forecast has been below the actual level since September of 2012. Even when euro-dollar rose, like in the beginning of 2013, people didn't adjust their forecast that much. With that in mind, let's look at the forecast for all the G10 currencies. Here they are. This graph shows the median expected change in the value of the dollar against the various currencies by end 2014. The dollar is expected to rise the most against the Swiss franc, 8.4%. On the other hand, it's expected to show the smallest gain against the Norwegian krone of only around 1%. These forecasts don't include interest income, which we saw last time can in fact turn a small loss into a profit in the case of the Australian dollar and New Zealand dollar, the two highest income currencies. Now, you might be tempted to believe that graph and go out and buy the Norwegian krone and sell the Swiss franc. However, wait a minute. Before you do that, please look at this graph. This graph shows the range of forecasts. That is the difference between the lowest forecast and the highest forecast for each currencies. This might be thought of as a measure of the market's uncertainty about the forecast. you can see that even though the Norwegian krone is expected to be the most stable currency within the G10, in fact, the market is most unsure about the Norwegian krone forecast. It has a 35% range. What that means concretely is that although on average, analysts think the dollar will rise about 1% versus Noki, some people think the dollar will fall by 8.6% versus Noki, and some people think it'll rise by 13%. In this case, the median is fairly useless as a guide to how you should invest. It reminds me of the story of 3 statisticians who go out hunting ducks. A duck flies up. One of them shoots 1 meter in front of the duck and misses. Another one shoots 1 meter behind the duck, and of course he misses too. The third one shouts, "We got it!" Maybe they got it on average, but the duck is still flying. In this case too, the average isn't likely to shoot any ducks. On the other hand, the distribution forecast for sterling is only 13%. That's a pretty tight distribution. It suggests that most people agree on the outlook for the pound. And if we look at the graph of forecasts for the pound, we can see that the market doesn't expect much of a change in the pound. And while there are, of course, some people who think it's going to go up and some people who think it's going to go down, the difference isn't that great. The low forecast for cable is 150 and the high is 169. Is there any connection between forecast changes and the range of forecasts? I looked at that and I couldn't really find any connection. This graph shows the forecast change in the dollar on the y-axis, the vertical axis, and the range of forecasts on the x-axis, the horizontal axis. As you can see, the distribution looks pretty random. I thought it might be that the smaller currencies that are less widely followed would have broader distributions, like the Noki, but the Danish krone has a pretty narrow distribution, while the yen distribution isn't that different from the Swedish krona. So I think it's pretty random. What's the conclusion from all this? Well, this is a long discussion leading to a short, simple conclusion, which is you can't rely on the market consensus. The so-called market consensus masks a lot of different views. It averages the views of people who think the dollar is headed up and people who think it's headed down. Some of them are going to be right and some of them are going to be wrong. Looking at all the numbers isn't enough. You have to understand the story behind the numbers and decide which story you believe. The numbers are really only the shorthand expression of a story. So that's my view. Any questions? Comments? Please feel free to message me at mgiller@ironfx.com or get in touch with your IronFX representative. This is Marshall Giller, head of Global FX Strategy at IronFX, wishing you solid trading.